Hello everyone, welcome back to the channel. Today we're gonna finally talk about the stocks that I'm watching and buying this month. I know it's already November 13th and I tend to post this video in the first 5 days of every month, but I've been posting a lot of videos on earnings as earnings season has been incredible. So today I'm gonna talk about the 3 stocks that I'm watching and buying this month and an ETF, as I know that many of you have asked me to talk about ETFs even more. So the first stock in this list is Facebook stock or Meta platform, which is its new name. We can see that the stock is currently trading at $340 per share, and yesterday it was up 4%, but we can see that it is down actually 10.80% since its last peak on September 7th, even though the stock got to 18% down. I do have to say that I bought when it was 18% down, as I love this company and I've been buying a little bit every time that we see a crash or a correction in the stock, and right now it is down beat because of everything that's been happening with Facebook. We know that all the allegations and problems, the legal problems that they've been having, all the problems with the whistleblower, which I don't think that will affect the company in the future. I do understand that they need to fix those problems, but in the long term, they should be more than fine, and even more with the new thing that they're investing money in. They're investing a lot of money now in the metaverse world, as we saw in the last weeks, and now they named their name to the Meta platforms, and they're gonna change their ticker symbol as well, as now they want to convert Facebook from a social media to a metaverse platform. And in my opinion, that is incredible because the digital world has always been the future and has always been constantly growing. And in my opinion, this is going to be the future as well, as we know that many companies are investing in the metaverse right away, as well as all these digital things like the NFTs and everything that's going around in the world right now. We can see that Facebook has currently a market cap of $948 billion with a PE ratio of 24.39 and a price to sales ratio of 8.41. Now they just reported earnings about a week or two ago, and we can see that they reported a revenue of $29 billion, all the way up from $21.4 billion in the last year. And analysts are expecting for this company to report a growth of 37% for this year and 19% for next year. Now, I do want to say that I love all of the FANG stocks and I normally invest in them monthly, but at this moment I like a lot Facebook because of everything that has been happening, and because of that the stock has been dropping, which makes it even more appealing. Now, stock number 2 in my list is Disney stock, ticker symbol DIS. We know what happened, and the stock is down massively in the past days because of their earnings. We know that the stock was down 1.53% yesterday, 10.49% in the past 6 months, as it is only down 9.75% in the last week after they reported earnings. But still, the stock is down 20.94% since its peak in March 2021. And obviously, I do have to say that we knew that the stock was going to see a correction because we knew that those prices over $200 was getting already really expensive and extended, but we didn't know how much it was going to drop. I love this stock below $160 per share, even though I was buying below $170 per share. But now that it is at $159 per share, it is way more appealing in my opinion at the moment. Now, what happened with this stock and why it is dropping? They reported earnings and they missed analyst expectations, as they reported earnings per share of 37 cents and analysts were expecting 51 cents. As well, with the revenue, they reported $18.53 billion, while analysts were expecting $18.79 billion. The other reason is their Disney Plus subscribers. They only added 2.1 million and ended the quarter with 118.1 million subscribers, and analysts were expecting them to end the quarter with 125.4 million subscribers for Disney Plus, even though the CEO of Disney, Bob Chapek, said during the Goldman Sachs Communacopia conference in September that segment growth had hit some headwinds and that Disney expected to add low single-digit millions. But still, Wall Street continued being bullish with this for the next quarter. But we can see that the revenue grew 26% year over year, and I know they missed analyst expectations, but they have been recovering nicely, as we can see their parks, Disney parks, experience or products grew 99% year over year, while the Disney media and entertainment distribution grew 9% only, but still is a nice growth. I understand something that many did not like was that their total segment operation income, we can see that was a decrease of 4% in the past year, ended on October, and that was one of the other reasons why the stock dropped. But still, we can see that Disney Plus grew 60%. ESPN Plus grew 66% and Hulu 20%. So yes, certainly they meet analyst expectations in both revenue, earnings per share, and subscriber growth. But still, they saw huge and a very nice growth for this company. I'm investing in this company as it is already down below $160 per share. I have an average cost of about $133 per share. So I'm actually up in my position, and it does not represent that much of my portfolio, which is why I've been adding more to this position currently. But I understand why it dropped, and I'm just taking advantage of this previous drop. Now, the third stock in this list is Lemonade stock, ticker symbol LMND. The stock dropped massively before it reported earnings, as it didn't drop because of the earnings, but because of an acquisition that we're going to talk later. The stock was down yesterday 2.87% to $63.96 per share, and it is down actually $65.10 per share since its peak in January 2021. And I do have to say that we were expecting this kind of crash for this company, because this stock got to $180 per share, and that was really overvalued for this company, which in my opinion we were all expecting this to happen, just that we didn't know when was going to happen. But now we can see that the company is trading at $63.96 per share with a market cap of $3.9 billion, and analysts are expecting for this company to report a growth of 33.90% for this year and 67.60% for next year. But now I know many question that why analysts are expecting a growth of only 33% for this year and 67% for next year. But it is because last year they started with range shooters in Q3. They were having a way higher revenue in Q1 and Q2 of 2020 in comparison to Q1 and Q2 of 2021 because of range shooters. It wasn't because the company was slowing down or decreasing. No, it was because of range shooters. We can see that since 2019, their customer has been growing a lot, and now they have 1.3 million customers, which was a 45% growth year over year. 84% growth for in-force premium, which has been growing a lot since 2019 from $95 million to $347 million. Now we know that they just launched this month on November 3rd their car insurance or auto insurance, which in my opinion is incredible because it's one of the most expected insurance from them, as it is one of the most popular products nowadays. Now I understand this company have been having a huge growth and even more with this new product. The company is trying to disrupt an industry that is very old and very strong as the insurance, which is the insurance industry. And this company is a very speculative investment in my opinion because of everything that has been happening. They are a high growth company. They are not profitable. That's why I'm only putting money that I'm willing to lose, even though I believe in the company in the long term. But as I do with every speculative stock, there is a risk in here, which is why I'm willing to take the risk, but as the reward might be incredible. But I have to say that it's speculative stock here. Now the stock dropped mainly before earnings because they announced that they were acquiring Metromile. And Metromile is their auto insurance, which in my opinion is going to be good for the company because it's going to bring a lot of data to the company. We can see the car-mounted precision sensors took over 400 million road trips in recent years, which obviously is incredible because that will help Lemon accelerate the process of expansion nationwide with their auto insurance product. As without it, it would take way longer for them, and this will help them with their path to profitability, which is obviously something that we are looking forward to because this company is not profitable right now, but we always like to know what are their plans to be profitable. Something that no one liked is that they are gonna do a dilution for this acquisition. As it says here, it implies a fully diluted equity value of approximately $500 million. And obviously no one likes to be diluted, and also many did not like that they acquire Metromile. Even though I believe it will help them with accelerate the process of expansion, many say that Metromile is a lost cause. As you can see, the stock is currently trading at $3.3 per share with a market cap of $418 million. The thing is that we can see that their revenue have been decreasing year over year, and the net loss is huge every single quarter. But in my opinion, that is going to help Lemonade with the expansion. As I said, obviously I want to wait and see for the rest of the year and even until the half of next year to see how this evolved and how they have used the data that Metromile will bring and what are their exact plans with Metromiles, because they said that this is going to help and accelerate the process and help with their path to profitability. But we can see that both Metromile and Lemonade are not profitable companies, so obviously I'm very interested in their plans with this. Still, this is a company that I like a lot. I'm up at this moment in this position as my average cost is about $56 per share, but I'm buying this stock below $60. I bought a little bit below $65, but I'm not buying anymore until it drops below $60, if we ever see it dropping below $60. Now, the last stock is not a stock, it's an ETF, which you guys obviously know I'm going to talk about this ETF, which in my opinion is the best ETF for anyone to start investing in it. And this is the VOO ETF, which is the Vanguard S&P 500 ETF. I started investing in this ETF this year as I opened an M1 Finance portfolio where I deposit money monthly and I invest in this ETF monthly. Doesn't matter if the stock is up, if the ETF is up or down. This ETF is 500 biggest stocks in the United States, which in my opinion it is very well diversified, but still have a nice growth year over year. It only has expense ratio of 0.03%, but we can see the return that has been having in the past years have been incredible. In a 5-year basis, it was around 16 to 17% yearly, and in the past 10 years as well, 16.5 to 16.6% yearly. But obviously in a 1 yearly basis, it was 29 to 30%, as we saw huge growth last year 2020, even though we were in a huge pandemic. Now, the 10 largest holdings from this ETF are Microsoft, Apple, Alphabet, Amazon, Tesla, Meta Platforms or Facebook, Nvidia, Berkshire Hathaway, JP Morgan Chase, and United Health Group, which in my opinion is very well diversified and will give you a nice growth, a nice return in the long term. And also, it has a dividend yield of 1.23%. So in my opinion, if you don't have the time or you don't want to invest in individual stocks because they are risky, this might be one of the best decisions anyone could make to invest in ETFs. And obviously, in my opinion, the best one so far is the VOO ETF, which is the S&P 500 ETF, as it has had a nice return. Yes, there are a lot of other ETFs with way better returns, like the VGT ETF, which I also invest in it, but this most diversified and proven that has had the best return so far. So these are the 3 stocks and ETF that I'm watching and investing in this month. Thank you and see you next time.